want to introduce Victor Boyajian. Where is Victor? Okay, great. I want to make sure you're around. So Victor heads Dentons' Global Venture Technology and Emerging Growth Companies practice worldwide. Victor focuses on representing emerging growth technology companies and Fortune 500 companies along with venture and private equity firms in a broad array of financings and strategic transitions from Silicon Valley to Boston to New York and around the globe. To this end, he consults senior executives, board of directors, and investment principals on a wide range of issues, including business strategy, finance, M&A, executive compensation, board governance, intellectual property, and litigation strategy. Victor particularly enjoys working on projects having a global component. I think the global keeps coming back, right? He is recognized for his deep network of relationships in the tech ecosystem. Victor's clientele reflects a cross-section of sectors, including fintech, autonomous vehicles, AI and robotics, digital health, big data, and cloud, software, digital media, mobile, internet, e-commerce. Victor has been an adjunct professor at the University Chambers, USA, as one of the leading practitioners in the sector. Under his leadership, Dentons has been ranked among the top 10 globally in venture capital deals, as reported in PitchBook. Victor, welcome. Thank you.
Well, why don't we have our panel come on up? Thanks for the introduction. I'll promise next time to shorten that up. Here we go. Alisa, Clayton, great. Sean. So I'm going to ask our panelists to introduce themselves once they settle down. We're going to try to figure our way around. I've heard the iceberg metaphor from Nikolai. I heard Bill use some verbs, sunk. Hopefully we'll figure that out. I'm sorry I have my back to the folks here. So Sean, why don't you start us off and just with an introduction of you and the firm?
Yeah, sure. So I'm an investment principal with JLL Spark Global Ventures. We are the corporate venture capital arm of JLL. JLL, as most of you know, is a global real estate services and investment firm. We've got about 100,000 employees globally doing roughly $20 billion in revenue per year. And our group is also a global investment business. I'm based in Frankfurt and represent us in the EMEA region. We have, in the last 5 years, invested roughly $400 million in about 50 startups in the prop tech sector. So all in technologies and business models that are revolutionizing commercial real estate.
Great, thank you. Clayton?
Hi, I'm Clayton Williams. I work for In-Q-Tel. If you haven't heard of us, we are a strategic investor on behalf of the US, UK, and Australian intelligence communities and national security agencies. We have about 685, I think, companies in our portfolio, $1 billion under management, and we invest in everything from strange robots to really boring enterprise software. Anything that large enterprise or government could benefit from, we invest in.
Hi, everyone. You hear me? My name is Alisa. I'm an investment manager with Henkel Tech Ventures. We're the venture arm of Henkel Adhesives. We're a materials company. There is another venture arm to the company that does our consumer goods space. We're interested in materials. We're interested in new business models. We're interested in Industry 4.0. Those are our investment areas. We invest in Series A, check sizes between 1 to 5 million. Our process is to establish a collaboration with the startups. We're very strategic in our methodology. And we work with our portfolio companies to establish the value within Henkel and outside of Henkel.
So that's great. So we've heard a lot about, and we all know, just being in market, that there is some choppiness in the markets right now. And I think you've heard some of our speakers just even this morning talk about that, and of course talk about how you how a portfolio company would convince you as investors to invest in. And I would submit to you, part of this is also the other way around, where you have to sort of distinguish yourselves and differentiate yourselves in the market as to why you're worthy of being around the table. And part of that thesis, I think, comes from the notion of, and it's the theme of our discussion, about collaborations. How we as corporate strategic investors are building relationships and can build relationships with you and the marketplace in a broad way. Not just customers, but customers, broader syndicated market, and just, again, a broader ecosystem, if you will. So I guess I want to just start and sort of understand, and again, I just caught your eye, Sean, so you're up. Sort of how in fact do you, when you're trying to get into a company, convince that company of your value add?
Yeah. So I think, as most of you know, the good companies get to choose who they take money from. And we've been pretty successful at getting into contested situations. I think one of the real USPs of this group is the way we're set up. So we have about half of our team doing investments and the other half does growth. And what we mean by growth is that's a group of people that has the sole function of helping our portfolio companies to grow. That means within JLL, but also, and more importantly, within JLL's customer base of real estate owners and occupiers globally. So when we're pitching a company on our ability to help them, it's always money plus. It's always based on how can we help your company grow, who can we introduce you to, and how can we make a successful partnership together.
So Alisa, just to thread that out, I saw you're nodding your head in concurrent. Again, I want to just tease that out a little more. How in fact does that happen? And vignettes from, on a no-name basis with portfolio companies, I think are always helpful.
Right.
To the audience.
So there are different channels that we help. Like I said, within Henkel and also outside of Henkel within our customer basis and with other investors. Some examples, within Henkel, we also appoint a champion to the business, and that champion helps us also navigate the key stakeholders for the technology of the startup, introducing the startup internally and externally. An example that we did is we put an application engineer in one of our portfolio companies. So it also gave them the expertise for the materials. He helped them set up their material lab, really get that top-level industrial expertise. Also save them an FTE in these times. That's critical. So beyond the actual funding, putting an expert in their company, which was challenging, I got to say, with legal. But we managed to do that. That we felt that for that specific company, that was the value add that we could give at that time.
So you answered my I'm going to interrupt for a second.
Yeah.
You answered my question I was going to ask. So that person was on your payroll.
Yep.
Stayed on your payroll. And was it 100%?
A short-term assignment, 100% for 6 months. Yep.
Yeah. Interesting.
And other things that we do is, yes, introduce to other investors. Obviously, we try to have non-conflicts there. So different stakeholders, if it's a machine company, then other machine companies or a materials company, and just bring them along to customer visits. We also set up in one of our innovation centers, so we set up like a demonstration for the startup, so that when there are customers coming in, we get to showcase our portfolio companies as well.
Interesting. Clay, so just coming again from your angle, just want to just level set, get this question out to everybody. Again, what's your method of, again, getting in front of opportunities? I mean, Sean mentioned that the best companies seem to always get funded. But how do you make sure you get in front of those best companies for your constituents?
Yeah, and as you might imagine, our constituents are a little challenging for some markets. So I think there's some that are very easy. The government's a very early market for things like drones or things that kind of have a natural dual use technology. But if you're trying to invest in things like fintech or vaccines or all these kinds of things, it can be quite challenging as a brand to attract startups. So what I think is really important is there's kind of two pieces. It's being a really good investor in the market, and so that way that it's not just you advocating for on behalf of your company and its ability to do business, but it's all your partners in all the deals that you've been in previously saying, you know, Clayton and In-Q-Tel are really great partners. They can get you connections. They can introduce you to your Series A or your Series B lead investor. That kind of reputational stuff is absolutely critical in order to be a good member of this community. And I think particularly about GCV and benefits of this group is that, you know, I have a very specific corporate customer, and each one of us kind of have that different lens. So together we make up a pretty robust set of markets that if we have a really good company, it can attack multiple markets. Being able to introduce across those lines is so critical.
So just following up on that, are you pulling in, and we talked about a little about this yesterday, are you pulling in other corporates or venture capital? Who's in first to an opportunity?
Yeah. It really depends, and that's part of knowing your syndicate, right? Is like Bill said, is if you have a really great partner who ends at Series A, well, they're a really great feed into us. We have an office of 3, and we're responsible for Europe, Middle East, and Africa. So we certainly don't do our own tech scouting. We rely heavily on syndicate partners, typically in the corporate venture space, to alert us to stuff that's interesting. That being said, you know, there's the back end. We don't really invest past Series C. Or at least we have very small checks that go into those rounds. So knowing your growth stage partners is also critical.
So again, Alisa, I want to just hear, and actually Sean too, because that's really important, the sort of sourcing of deals that Clay's sort of hitting on. Are you in market, or are you just waiting to be rung up by a prospective syndicate partner?
So there's a lot of passive scouting. We get deal flow from the funds that we're invested in. We're at events like this that we pick up on opportunities like that. But there is dedicated scouting projects that we know of a certain challenge that the operating business is looking for, and we go out and look for those opportunities. If I could just add before, I think one of the issues we had mentioned also in our prep was the projects that we put on these startups for the collaboration. So we have to be very mindful. These are startups, and we don't want to overwhelm them with our projects. Obviously, they have other customers that they want to tend to and so on. So we are very mindful of that, and we do have that champion, like I mentioned, from the business, really prioritizing our projects. There was also an issue of introducing portfolios one to another. Like, do we have that synergy, I guess? And even with that, we're very, very mindful not to use our heavyweight kind of investor hat and put maybe a project that's important for one portfolio company and kind of push it down on another startup portfolio where it's not in their strategy. It's not something that they really should be spending time on. So we really do have to be mindful of the startup's growth plans and strategy and be aligned with that and not try to deviate from that as much as possible.
Sean, any?
I mean, we maintain relationships with all the relevant VC funds in our space, and I would say we also are very active at all the prop tech events that are relevant. So we have a pretty strong presence, and the JLL brand is very well known in real estate. So there is a good mix of active versus passive sourcing. We do both. The best deals historically come from other VCs, though. And, you know, that's something where, you know, another professional, and you guys all know this in the room, that's something where another professional investor has actually taken the time to look at something and has found something and is now passing it on to you. So, therefore, I think we view building trusted relationships with other professional investors to be one of the most important things we can do to find quality deal flow.
And so how actually, some of this might be obvious or intuitive, how actually are you building those relationships with the venture community, if you will? Is it just with those partners sitting around other portfolio company tables, or is it something bigger, broader?
So we have two things we do. I mean, first of all, we talk to all the relevant VCs in our network and in our space all the time. Some of them are later stage, some are early stage. We've invested in a few funds that are seed stage, so earlier than we would normally get in. And through kind of seeing what happens in their funds, we can see through the filtration process some of the good ones and get an early look there. And then with the later stage funds that are in our space, we have regular dialogue, and we basically, we try and be as good of a partner to them as they are to us, right? And show them relevant deal flow from our network as well.
I think another thing that's important is that each one of us has an expertise or a lens based on the brand that we have. So either you're very, very good at material science or know how large buildings operate. Being able to know what your unique value is so important, because that's what the other investors are going to come to you for. So for us, it's tech diligence. We have 30 PhDs on staff. Because we're a not-for-profit, we can take that profit and spend it in-house on diligence teams. So we have investors come in and say, hey, is this cybersecurity company legitimate, or is this fusion company legitimate? And we have people on staff to be able to answer that question. That's invaluable in the market. So make sure that you understand what unique value your brand has and what resources you have from your corporate to make those investments.
It's a great point. I was just talking to some OEMs in the automotive industry, and same concept, obviously. You would think that folks looking to invest from the venture community would rely on the strategics in that regard because of deep industry expertise, but also network.
I think it's the perfect partnership or the perfect board kind of representation would be 2 or 3 strategics and 1 or 2 VCs. That's really, you get really all of the diverse and the industrial expertise there on the board. That would be amazing.
So wait, let's roll that back. So you're saying on one board, roughly, having more than one
strategic.
Corporate strategics.
Yeah, from different lenses, as Clayton said.
Yeah, I think the challenge, the blessing and the curse of the brand is that you get into a deal because of your brand, unless you're just a phenomenal investor, and there's a few in the room. And then the next board meeting is, well, hey, why don't we have revenue from your brand? So you always are answering these questions, and so one, you're always working to make sure that you have some sort of unique value that you're providing, and then 2, if the answer is, hey, none of your strategic investors on this board are generating revenue from their corporates, maybe there's a foundational issue with the product market fit, or there's some sort of product issue that we're focused on the revenue as opposed to the actual widget, right?
So I still want to tease out this notion of having more than one strategic on the board or in the company, on the cap table, however you want to phrase it, and just briefly think about, while our theme here is collaboration and collaborative relationships, it seems that there's a tension on the one side with that notion, with also sort of your desire to drive your own corporate goals.
Right.
And it could be in conflict with a competitor. Corporate competitor.
The beauty is finding those strategics that are not competitors. If you're talking about like an automotive deal, so an automotive company and a materials company or a device company. So that's the beauty. That's the trick.
Yeah.
So we see that a little bit differently. We pursue open relationships with our portfolio companies, and we do not have a problem if one of our big competitors wants to work with that company, because we're focused on 2 things. We want strategic cash flow, but we also want financial returns. And our view is, if one of our portfolio companies is getting interest from one of our competitors who also wants to work with them, then the company is going to be more successful. And ultimately, that's going to be good for us. We view, I think it's important it's important for your reputation in the venture community to not engage in rent-seeking behavior, but rather to always be on the side of the entrepreneur and shareholder value. And if in the end somebody in your company says, hey, we actually want to buy one of your portfolio companies, well, that's a great outcome, but they need to bid just like everybody else.
So I want to just jump on that point, if I could. So when you're investing, are you investing with an ultimate view towards something bigger in terms of strategic, i.e. an acquisition?
Definitely
Because that, pardon?
definitely not.
Definitely not.
No, I mean, and if you look statistically, of all the companies that we've invested in, I think only 2 have been purchased by JLL. So it's clearly, and that happens from time to time, but it's certainly not part of our strategy and not one of the reasons why we would go into a deal. It's nice if it happens. It's certainly great to have an exit. We view an exit to JLL just like any other exit. And it's great to have an exit, but it's not that we're trying to do something specifically only so we can create a pipeline of future M&A targets.
So let me ask you a really, anybody on the panel, a really basic question on that. I mean, what's the end game if you're not trying to pull the portfolio company back in to the company? Are you just doing it for financial return purposes, or?
Yeah, I'll take an interesting view on that because I think when we do talk about exclusivity or these kind of things, no startup says my total addressable market is this one company strategic. Right? They talk about the entire market, and I think we as investors don't want to close those doors because you're trying to build this company up as large as it possibly can. When you want to have exclusivity, that's at an acquisition stage. That's where you're saying, okay, this is so important to our business, we want to purchase it, and then we can make those rights because it's ours, right? We obviously don't acquire things. So we find partners in the space to be critical to kind of expand that piece. I think the challenges that our customers have is that they find the insights of the investment very valuable. So to know what tech trends are, to know what is happening globally and regionally across technology trends, that's something that our corporates, I think collectively really value from their venture arms, but that's not valuable to the companies. And we have to be aware of that. If we get that imbalance incorrect, we're not participating in I think, a collaborative way that's useful to our startups.
Mm-hmm.
Right. A lot of the startups that we invest in, it's the same thing. We want a window really into a new emerging type of technology and so on. But there definitely are deals that we look at as a strategy that we would like to acquire at some point. There are startups that go directly to M&A that we as a CVC kind of identify. We don't want to take the risk of someone else kind of engaging with them, so we do acquire them immediately. We are a funnel to our M&A team, but the majority of the opportunities, they're too early for us to acquire, I would say. Our acquisitions are larger tickets. And we also don't want to stifle the startups. I mean, we might have a certain part of the market for that type of technology, and there's so much opportunities beyond Henkel's. And so we kind of think of it as an incubation period, allowing the startup to grow independently without bringing them into a big corporate setting with our different guidelines and so on. So allowing that time to develop the technology further, and one of the routes would be acquisition, yes.
So just pick up on a couple, I'll pivot slightly, but to pick up on a couple of words you used, Alisa. A lot of times corporates are purportedly in market to spur innovation and to attract entrepreneurial talent in a way that perhaps they could not attract or develop internally. Is that part of your thesis or strategic sensitivity as well?
I mean, there is the PR effect that we are investing in innovation and we are an innovative company. But I think for the bottom line, we're looking for innovative technologies that it either doesn't make sense for us to develop internally, or just the time to market for us to develop where a startup is already further down the line. That makes much more sense. So I would say that's it's on the list, but probably further down.
And for you folks, including yourself, who've pulled a company back in through acquisition, if you can share some insights there. I mean, have you found a cultural divide, if you will, where you have straight up entrepreneurs coming in from acquired into a more established company? You were talking about, Alisa, a little earlier, big process, that kind of thing. How does that all play through?
So I can continue on. We really set up the investment period, which can be several years, to get the company alignment with whatever technology we're hoping to adopt further down the line. So it's not such a clear kind of cut, okay, that's it, they're coming in. There's this long process of integrating them into the company once we understand really that the technology is something that we want. That's an additional benefit to the investment period, that it's not so immediate, the acquisition. Regarding stunting the entrepreneurial growth and so on, so you're looking at those entrepreneurs where there is chemistry to begin with those entrepreneurs. And so we set it up in a way that they're allowed to grow also internally.
We obviously don't acquire, but we do, about half our investments come with a government contract. And that's an 18-month work program to say, hey, this is great, but it needs to be cyber secure to these government standards. Or, hey, it's really great cloud technology, but can you have it work on premise? And so we actually have a team internally at In-Q-Tel to do program management, to do validation of requirements, and to help quarterly meet with those companies and with stakeholders in government to ensure that there's a really strong integration. Because without that, the technology has to be so impactful to modify a large corporation's workflow. And frankly, not all your investments will meet that mark. And so you have to make it a much smoother integration path in order for a successful adoption of the technology.
Sean, are you, I want to just keep rolling it back into the earlier stage in the process. We talk about relationships in terms of understanding what your corporate needs are. And Alisa, you again might have good insights here. Actually, Clay as well. How do you know what your constituents are looking for?
Oh, well, that's easy. I mean, we have regular dialogue with all the business divisions.
Say that again?
So we have regular dialogue with all the business divisions. We know what their problem statements are and things that they could be looking for, or where they say, hey, there's something that we need. And those are not exclusively the things that we look for, but definitely part of our list of priorities, for sure.
Just so what is that as an inside outsider, me, or outside insider?
Yeah.
What does that actually mean? Does that mean you're just walking the halls and you're bumping into people in the halls and you're talking with them, or are you having regular quarterly or monthly meetings?
That's right. We have a regular cadence with the leadership of the business divisions where we talk about things we're seeing, things that they're seeing, needs that they might have, and we can give them some ideas and insight into how startups can help them solve those problems and do things in a faster way than they would be able to if we had to develop something internally, for example, just like Alisa said, right? So that's part of the value add you bring. I mean, if you think about it, you know, if you're a financial VC, you spend a lot of your time fundraising and, you know, talking to your LPs, right? We spend a lot of time talking to the corporate because they're our LP. And, you know, hopefully the time that we spend is, you know, well served for them and also for us.
Clayton, the same with you. You've got like maybe, I don't know, but broader, generally different.
Yeah, I thought working for one government was hard. Working for three is good luck to the NATO fund with 27.
Right, exactly.
I tip at the cap. We have a very similar process. So we have a problem set, and we specifically say don't ask for like a 10% better widget. Say what your problems are, and then allow us to find technologies that address those problems, because it might not be obvious that a different sensor modality may be able to solve something that you weren't even thinking about when you originally wrote the problem. We do that annually. We have both the governments collectively provide their problem set, and then we create a problem set response. So we say, hey, this is something that we think is very active in venture currently, or, you know, this stratospheric technology one is not something that's an active venture market, so we won't be looking for solutions for you this year in that. You know, there's other tools you have within your corporation to pursue those areas of technology. Mm-hmm. That's critical to understand what venture can bring and what it might not, or what maturity that different technology is, to see if it's something that you can use today or if it's something strategic to think about 10 years down the line.
Great. I don't know if you have
Yeah, we actually see our operating businesses as our customers. I mean, very similar to what you guys are doing. And we want to make our customers happy, and so we understand we really get to know what they're looking for. But we also bring that challenges when we are seeing startups that are not on their search fields, that are not on their original plans, and we do try to challenge them and say, okay, could this be interesting? Often they do say, that, yes, it could be interesting, but they don't have the resources to put on it. And that's where we kind of can step in as a CVC and allow for that time until the rest of the pieces kind of fall into place.
Great. So we're basically out of time. I've got the hook from Nicola. Just go down the line quickly, 30 seconds, no more each. Advice to the audience, just like a snippet. If you had to think of your best takeaway for these folks.
Yeah, I would say never forget to focus on the dual mandate. Everyone here, that's your job. That means financial and strategic returns, or strategic and financial. And you can't have one without the other. I know a lot of CVCs, maybe you're not, incentivized by your financial returns, but you cannot do investments just because somebody in your corporate thinks that, this is a good idea if it doesn't look like it's going to make financial sense. Because in the end, your portfolio won't be what it needs to be, and that's just not going to work. So just always remember the dual mandate. That's everyone's job.
Clayton?
Mine is, in this economy, that the number one thing is helping your startups right now. And so that's not cost savings, that's creating revenue and finding interesting ways either to help them internally with your corporations or externally to other partners that you may know. It's absolutely critical to be a good partner right now.
I'll just add on to that, the value that you bring to your portfolio startups and even your partner startups. That's really critical. Beyond the revenue, it's also technology insight and so on. Really follow through on that statement, bring value, additional value to the startups.
And the final point I'll make is just make sure, we talked about the company, the board, the founding entrepreneur, spend time with her, him, in the ways we're talking about. Don't forget that person, and introduce them into your other portfolio companies. I think that could be very valuable as a tool. So thank you again for your time. We enjoyed it. Thanks to the panel. Good conversation. Thank you.